Welcome back to Rock Stock Channel. It is Wednesday, April 16th. I recently had the privilege of sitting down with Ash Bennington on Real Vision for a wide-ranging conversation about critical minerals, energy policy, and the shifting global landscape around electrification. We discussed lithium's recent price collapse, the broader commodity cycle, and how geopolitical and economic forces like tariff policy and supply chain realignment are impacting markets. There was one company I didn't get the chance to bring up during the main conversation, and I think it's one of the more overlooked opportunities in the space. It's worth staying through to the end, where I'll circle back and share a brief overview of that company. Enjoy the interview.
Welcome back to Real Vision. I'm Ash Bennington. It's my pleasure today to welcome Howard Klein, founder of RK Equity, a host of Rock Stock's channel, and sometimes known as the Lithium Bull. I guess today, the last few days, I should ask you, still the Lithium Bull?
You could have been asking me that question for the past 18 to 24 months because, lithium has gone on a wild ride up from the price of $6,000 to as much as $80,000, and now all the way back down to about $9,000. That's the broadly traded lithium carbonate price. I do think lithium has overshot on the downside and remain bullish the long-term thesis because demand from a whole host of a whole host of applications that require lithium, which we can get into in this program, are still very strong. Supply, we didn't think would be able to keep up the last couple of years. It has, and that's resulted in a oversupply versus the demand. But the demand still is still a very small market, lithium, compared to other commodities, and the demand function growing 15 to 20% per year. It's unlikely that supply will be able to keep up for the next 5, 10, and 15 years. So these prices at 9,000 are likely to go higher in the next couple of years. You had me on the program. This is, I think, the third time. The first time, I think, was in 2017 or 2018. Very few people had heard of lithium. It was a good time to be on your program then because people who followed our recommendations back then did very well. But it's a boom bust like many other commodities, and we are in a massive bust at the moment. So the answer is yes, medium to long term, I am bullish. Lithium is better known than it was because at 80,000, it was on CNBC and Wall Street Journal almost every day. Elon Musk was talking about it 24 to 25 times in quarterly conference calls. So people are aware of it. It's not much talked about at the moment, but I'm still bullish. So long answer, yes, and we can go into the details of it. But this conversation will be wider ranging than just lithium because commodity equities or commodities, I think, are very topical in the news regularly with Trump. So critical minerals and a whole host of other commodities to feed AI and the age of electricity. So we'll get into that in this conversation. So thanks for having me back.
Well, thanks for joining us. Listen, this is a double whammy question because you have, as you point out, what's the peak to trough decline on lithium from the most recent high? It's like 85 to 90%. You've got that component, and you also have the generalized bear market or the things that are happening right now. Absolute price whipsaw. I mean, news headlines just flipping around. We're up here this morning. Let me just give this to folks who are watching live. We're up almost 4% on the NASDAQ post cash trading here about 30 minutes ago here in New York. Let's talk about both of those things. So as you point out, obviously extraordinary declines, very volatile market, lots to talk about there. Frame this up for us in the context of the bull case for lithium after one, the steep declines that you just discussed, and two, the generalized state of the market, where we are right now with everything that's happening in U.S. equities.
I think let's start with the latter. I mean, the U.S. equity market, I'm reminded of COVID times 5 years ago. And the corollary is COVID caused supply chain disruption, and supply chain disruption resulted in, a lot of volatility, and the tariffs that Trump is implementing or negotiating posture is messing supply chains globally, right? With there's a lot of uncertainty, and it's supply chain dominated, and markets don't like uncertainty. So but if you fast forward, from the height of the pandemic, March 2020 to September of 2020, the market was much higher. There was obviously fiscal stimulus, monetary stimulus. There was a lot of differences between COVID and now, but looking forward 6 months from now, I think a lot of this tariff volatility will be resolved. It is the art of the deal kind of negotiation going on, by Trump. But more as importantly as that is the legislation, the big, beautiful bill that's making it through the congressional sausage grinder over the next number of months. He's very focused on having his 2017 tax cuts extended, maybe indefinitely. He wants to add things like no tax on tips and other measures. And that's making its way through. And I think by the end of the summer, again, going back to the COVID, what you had was a fiscal stimulus and you had a monetary stimulus during COVID, which led to this, very big boom. They reduced interest rates to near zero during the pandemic, and you had major government spending, happen. It'll be different this time. It won't be so much government spending. In fact, you're getting, spending cuts. However, tax cuts will be a major fiscal stimulus, and you could have short rate cuts, from Chairman Powell. But the main reason for as listening to Treasury Secretary Bessent of the current policies is to kind of get the 10-year down, and the 10-year has come down quite a bit because we have to refinance, I don't know how many trillions of debt, this year. So a large focus has been on the 10-year, Bessent, and there's been a lot of reporting about that, getting Trump to focus more on the 10-year than on the stock market as an arbiter of how he's doing in the short term. So commodities are sensitive to lower interest rates as well, and should respond to that. But the fundamental policy of reordering, on tariffs and supply chains, there's a lot of this is China centric. The we have the biggest trade deficit, I think, with China, with like 1 trillion. China's been exporting, an enormous number of cars and batteries and other things on a global basis. And, so reordering that, kind of decoupling from China in a number of ways, in particular in the critical minerals space. There's been a widespread acknowledgement, and there's a slide here. China is leading, critical minerals production in copper and nickel and aluminum and the like. There's a widespread understanding by the Trump administration, as there was the Biden administration. The Inflation Reduction Act actually had a lot of measures to address this over-reliance on China for a lot of these raw materials. So, I think there's a deal. The art of the deal's happening. There's going to be maybe there's a grand bargain with China. We don't know. A few months out, we'll see what happens. But commodities broadly, if you look, Trump has passed executive orders in relation to critical minerals. He's added, certain metals to the list of critical minerals, including gold and copper. So he wants to, he wants Greenland to become America for its critical minerals. He's negotiating with Ukraine a minerals deal. So minerals is just very, very topical on his mind. If you look at his Secretary of Energy, Chris Wright, and Doug Burgum, they've created this, National Energy Council. He's focused on energy dominance. Energy is defined not just as oil and gas, but includes other nuclear and geothermal We'll see if, how supportive or not he is of solar. He's not been a huge supporter. He's been anti-wind, but in general, energy dominance is on his mind, and we recognize the broader context is China's caught up and it is more advanced in a lot of technologies, including electric vehicles, batteries, and in some cases, there's a massive competition in robots and drones. America's leading in AI, but the DeepSeek showed that China's, not all that far behind. And China's investing an enormous amount in electricity growth of all types, coal, nuclear, renewables, and we are in an age of electricity that demands, this is a very substantial topic, the age of electricity. And that's very, from data centers, from robots, drones, rebuilding military, in addition to electric vehicles, everything. If you believe in humanoid robots, there are going to be batteries in those. So, and a lot of these applications require a lot of traditional metals, but also a lot of niche metals, rare earths, lithium, graphite, cobalt, lesser known commodities. So I see an event here like the age of electricity led by AI, et cetera, and the electrification of the world as a similar type of commodity intensive event as we saw in the 2003 to 2012 period, which was a commodity supercycle based on China's rapid industrialization, right? China just, moved in those 10 years like America did from like the 1950s to the 1990s, in terms of refrigerator demand, air conditioner demand, auto demand, so that industry and then the property sector, that was very metals intensive. And then you had a bust during 2012 to 2020 in a lot of metals. There was overcapacity, so commodity equities follow commodity prices, and commodity is like infrastructure investing. It's very long cycle. It takes 5, 10, 15 years to build mines. So it's not like you could switch on and off supply of various minerals, immediately to, to address any kind of, supply chain bottleneck. So I think there's a lot of dynamics. Commodities are undervalued. Again, this chart, if you look at a long-term chart, friends of ours at a fund manager, Gering Rosenzweig, tracking commodities relative to the Dow. And this shows that commodities are more undervalued than I think they've ever been. And if you look at that chart and you go back to like 1999, the dot-com bust, that began a very substantial rally and that super cycle that I just discussed. Are we, in a tech bust now with the Mag 7 representing, I think it was like 40% of the S&P 500 a couple of months ago? I think Chamath Palihapitiya was raising that as an issue. I'm not saying that we're going to have like a major bust like the Ciscos and the Qualcomms and whatever Pets.com, back then. I am a believer in these technologies, and I think companies like NVIDIA and Google and Amazon will do well. But from a relative value perspective, from a thematic investing perspective, are we due for a reversion to a mean, a switch? You approached us, Ash, you reached out for the first time, for an interview in a long time, suggesting, are we going to see a switch from U.S. equities or large cap growth into commodities? I took that as a signal, as a tell, alongside some other inbound data points I've been getting from some investment banks asking about, defense metals and rare earths and things like that, because Trump's talking about it all the time in a similar way that Biden was talking about clean energy for much of his administration. The Inflation Reduction Act was largely a climate bill, and he put in massive supports, some of which Trump wants to eliminate, like EV tax credits and battery investment tax credits and the like. That stimulated a thematic to invest in clean energy technologies. So solar stocks did well, and a number of lithium companies were suddenly put into these ETFs that were focused on clean energy, right? So you were looking at a chemical company, a mining company that was suddenly defined as a clean energy company. So you had these massive inflows, which exacerbated, the rise of Albemarle and Piedmont Lithium and Lithium Americas, a few of those companies during that cycle. And then all of that underperformed, and you saw massive outflows. So a lot of these stocks have overshot on the downside. I see a similar dynamic playing itself out under this administration, but the thematic will be more mining focused funds and broad mining focused funds, some rare earths, critical minerals, defense metals. So to the extent you start to see inflows into these ETFs, and we just passed the first quarter, gold did very well in the first quarter. Will we see a lot of investors come into gold funds, and because gold equities are actually underperforming the gold price, if you start seeing inflows into gold funds, financial advisors, and their customers will start saying, okay, well, what other metals might we invest in? So
Well, let's talk about all of that because there's so much here. And by the way, what an excellent summary, Howard, at the top of the show, and exactly why we reached out to you. I think understanding these thematics, understanding the broader, bigger picture that you talked about here. I mean, look, there are layers to these markets. You have what's happened here in terms of the price gyrations over the last couple of days, speculation and reaction to rumors of, or we should say, actually, the beginning of the implementation of tariffs. About trade policy, but then these ideas that you're talking about here, these are much more deeper structural changes in the way that energy gets delivered. You talk about this idea of broadening the notion of what energy is to include not just traditional oil and gas that most of us think about, but some of the rare earth elements, some of these elements that are used in battery technology for energy storage. Obviously, this is something that is not just complicated at the financial level, but this is stuff that's chemistry and physics and engineering about the way that, for example, we are going to create, transmit, and store energy in the future. These are big, big ideas. I want to bring this back to lithium for just a second and use that as a leaping off point to talk about some of the other topics that you've touched on in your opening statement here. And I want to talk a little bit about how people understand the price of lithium. This is extremely confusing to me. I know based on the chart data, as I said, I think we've seen the whatever the peak to trough number is, 85 or 90% drop. How do you measure the price of lithium? This gets complicated because there are multiple different grades, multiple different constituencies. It's measured in yuan, it's measured in dollars. First of all, let's talk when someone says lithium has declined 85 or 90%. What are they referring to? How do you measure the price of lithium?
Look, there's a lot of different price reporting agencies, and there are some nascent, commodity trading indexes on the CME. Some are in China, but it's no different than oil, natural gas, iron ore that have different prices depending on different grades, different geographies,
Right.
But broadly, there are, there's the GFEX, the Guangzhou Futures Exchange, which started about 18 months ago, which is China based. The lithium market is the biggest buyer by far is China. So the most activity in terms of lithium chemical trading is in China. There's a precursor to when we talk about the lithium price being $9,000, that's a lithium carbonate price. That's the most liquid and it's the largest market from a chemical point of view. But there's also a substantial precursor material, which is a hard rock mineral called spodumene, and that trades as well. But that's that trades right now at about $800 a ton. It takes about 8 units of spodumene to make 1 unit of lithium carbonate, right, as a rough measure. So the market focuses on both the chemical price, and because a lot of publicly traded companies only make the spodumene, they track the spodumene price as well. So, but the CME has recently introduced a few years ago a lithium hydroxide contract. I think they also have a lithium carbonate contract. Lithium carbonate and hydroxide are two different chemicals that go into different batteries. Lithium carbonate tends to go into lithium iron phosphate batteries, which China dominates, and lithium hydroxide tends to go into nickel-based batteries, NCM and NCA, which is largely used by Tesla and Ford and GM, but not exclusively. There's a shift in that. So I don't want to overcomplicate things. When I think about the lithium price, you could just think about the lithium carbonate price and price reporting agencies like Fast Markets, Benchmark Minerals, Wood Mackenzie. They track these things on a daily basis. On a Bloomberg, you can call up, where the lithium price trade. Those trades tend to be, small volumes. There have also recently been auctions. Some of the bigger companies like Albemarle have been undertaking auctions for a small amount of material. So there's still a lot of price discovery happening and different methodologies. But I think, if you're on X, there are various people who are posting, the Guangzhou futures price. We post through RK Equity the CME hydroxide price, I think, on a weekly basis. So you could see, every Friday how the curve is traded relative to the week before. It has been in contango. So it shows 2 years out, I think, around 15,000 compared to 9 or 10,000 today.
Or let me ask maybe the simplest question, which is when you refer to the price of lithium, when you were talking about the price percentage changes over the years, what is the general benchmark that you're talking about? And maybe when you hear the average guy or gal on the street talking about it, when they say, hey, the price of lithium is up 20%, is it generally carbonate that they're talking about, or is it the spodumene precursor?
I think most will talk, it's the carbonate price.
Yeah.
But if you're the guy or gal on the street in Australia, you might be talking about the spodumene price, because that's where a lot of the spodumene is produced.
And in terms of lithium carbonate, for people who don't have a Bloomberg terminal sitting on their desk, what is generally the way that they look at that?
I'm not sure what you mean by that's the price at which, if you look at the lithium carbonate price and you're an investor in Albemarle or some other company that is producing lithium carbonate, you would say, okay, Albemarle is going to sell their product for this price, this quarter. And what is their production going to be? And what's their production cost like to estimate what their profitability, might be.
So is the answer that you're essentially you're relying on the producers in their quarterly reports to give you a price? In other words, is there a way to get something that's a rough proxy of this, Yahoo Finance or wherever else, where people can just call up a number to see the price of lithium carbonate? I know this doesn't have the transparency of a U.S. equity, for example, but how do people get a sense of where the price of lithium has gone over the last 3 days or 3 weeks?
You could subscribe, I think, to Fast Markets. They may even offer this for free. They put out daily price reporting. So this is based on their calling around, and they come up with some number. You can go on X, and I forget, there's a couple of people you can follow who are publishing like on a day-to-day basis where the Guangzhou futures exchange. You could probably, I don't look at the price every single day, but I think Shanghai Metals Market, SMM, is a Chinese data provider. And I think on their website, they publish every single day where the lithium carbonate price is in China. You can go to the Chicago Mercantile Exchange to look at the hydroxide futures market. And on Bloomberg, I don't have a Bloomberg, but I'm sure there's a code to look at the lithium carbonate price every day.
All right. So let's jump over to some of the charts that you have to look at some of these longer term pricing trajectories. Let's jump right in and bring those charts up.
Okay. Well, I think the one that's up here now is what we talked about earlier, is that commodities are more undervalued than they've ever been relative to the Dow. And this is a broad-based commodities. This isn't commodity equities necessarily. I'm sure this includes oil, but it's just a data point that Gehring and Rosenzweig, friends of mine in New York who manage a commodity, equity fund, point to, and they're arguing that this is a very big contrarian bet. This could be like those, you look at those up cycles. If you look back at 2011, commodities were overvalued. So from 2000 to 2011, it went from the most undervalued to overvalued. So we're even more undervalued today. So as a rotation, maybe the Dow is overvalued, and maybe the Dow is going to come crashing down, and commodities, will rise relative to that. But I just, again, going back, the Mag 7 represented not long ago, I think 40% of the S&P 500, and commodity equities, for a whole host of reasons, big cap mining and other, people don't think in America about mining too much, and they think it's a dirty industry, and they don't want to really think about it. And it is volatile, and it is capital intensive, and as a result, it doesn't have stable, predictable, consistently high return on equity. It's not software margins like the Mag 7, right? That these are phenomenal companies that push out. They have great market positions and real moats. Most commodities are commodities. The companies don't have moats for the most part. But again, at certain moments in history, they could have super normal profitability, after periods of time of having, not such good periods of profitability. And profits matter, but a new dynamic is at play here in that, the world realizes that too much of the world's supply of commodities is in the hands of China, and governments in the US and in Europe and elsewhere are saying security of supply is more important than price in a lot of cases. So when you have that attitude, and that's been China's attitude over the years, China, like when commodities were overvalued in 2010 and 11 and 12, China was paying enormous prices to secure the commodity assets of certain companies. If you now have America and Europe competing for those same assets to ensure that they have the supply of them, they're going to be less worried about the price that is paid for those assets.
Well, Howard, that's very well said, and it speaks to precisely what we're seeing right now in trade policy and what we're seeing reflected in markets based on these gyrations in policy. I want to talk to this chart here because we've just gone from this very detailed conversation about lithium and breaking down the microdynamics of how that market works to this very broad picture view. When you bring up Figure 1, once again, this idea of the ratio of commodities to Dow, this very big picture overview of the relative price over 125 years of the commodities versus equities. And it's a really great chart because it takes the exact opposite side of the view, this in terms of the zoom level that we're looking at. This is the big picture here. This is the idea of the price of commodities versus US equities. And it's such a powerful chart because it shows you so much information over such an incredibly long period of time, and it boils down so much. And what you see when you look at this very clearly, and this is the rise of large cap tech that you were just talking about, the relative massive weighting of the of U.S. equities, particularly big cap tech, because that's where all the growth has been in terms of price, in terms of market capitalization. And you see that in this chart from the 2012 peak, the overvaluation. I guess that's about the 3.5 X point there, where that dotted line commodities overvalued is. And it is just a very, very powerful visual that presents this very, very big picture, very long-term narrative that you've just discussed, Howard. Great chart.
Well, thanks again. Giving credit to Gering and Rosenzweig, who wrote a very interesting piece in connection to this chart. But I let them, kind of speak, for themselves on it. But one takeaway, from it that I took is that they're arguing that there is to some degree, a fundamental macroeconomic shift in global monetary policy. Like a lot of what Trump is doing, is ripping up the last 30 years of globalization as we know it, and back in the day, the Bretton Woods system going off the gold standard. I don't know, in the late 80s, you had the Louvre Accord, from currency point of view. So there's some talk about a Mar-a-Lago Accord, right? So they're arguing that there's something broader at play here from a global reorientation, a new world order, that's monetary based as well as supply chain based. The next chart is an infographic. I think the data comes from Benchmark Minerals Intelligence, a good friend of ours, and they're just basically saying the energy transition, which was a very topical phrase under Biden and in Europe, and Europe still uses it. I think Trump's energy secretary, Wright, said there is no energy transition, there's energy addition. But to the extent you believe in AI, data centers, electric vehicles, drones, robots, all these things, it's very commodity intensive, in particular of copper, of lithium, of nickel, and graphite. And this infographic just shows the size of each of those markets. Copper being the biggest of the metals, but also showing, so it's a 23 million ton market, but it's saying it needs 3.7 million new tons over the course before 2030, which is a very short amount of time. And then they quantify that in how many new mines is that based on some average mine size of a copper mine. So it shows that copper and lithium are require the most new mines to be built. I think I can't read this exactly here, for lithium, but the lithium market today is 1.2 million tons, and most forecasters are calling for it to be at least 3 million tons just in 5 years, and to grow a lot further, from that. So,
But by the way, for people who may be scratching their heads a little bit about how retail investors participate in this, we're going to talk about some of those companies that are proxies for the underlying price of lithium, as well as the underlying bullish use case in just a second. I just want people to know that there's something coming that is actionable.
absolutely, we could switch to that. I mean, like, broadly, this just shows that there's a lot of new mines need to be developed, right? If we're going to, have the supply to meet all of these applications, and if demand is greater than supply, price has to go up, right? So, and commodity equities follow commodity prices. So, if you believe in this shortage thesis, the price of a lot of these commodities has to rise in the next few years. So.
And by the way, that obviously was the implication of the last chart. You take these two things together, right? This idea of energy addition. By the way, that's a great phrase. Not energy transition, energy addition. This idea of the expansion of technology for production, storage, transmission of energy. And then you look at that chart that we just showed, where essentially you see the relative. Well, I don't want to use the word depression, but the relative decline, and on a cyclical basis over the last, call it 10, 12 years of commodities versus equities. So now you put that in with the rise of technology, this development of additional sources of energy tech, and you get this thesis.
That's right. And then the third slide here just shows China leading in critical minerals production. So reshoring of supply chains, to address this China dominance is a major theme. China, even in their most recent retaliation, meeting, head to head the 34%, tariff increase, they also put certain rare earths, saying we're not going to export these, rare earths. So China's used rare earth, as a weapon. And if you note, there were a lot of exclusions to Trump's tariffs for critical minerals. They said, we're going to tariff all these things, but just like semiconductors, they said a whole host of minerals would not experience that tariff because he knows that we don't have domestic production of it.
Right.
So that combination, combined with just commodities generally are viewed as inflation hedges. So reshoring of supply chains is inflationary, right? It's going to cost more to build more stuff here. It's metals intensive, but the America doesn't have so many miners and engineers and chemical people. Like that, there's going to be a big demand for these skills, and plus labor costs in general are higher in America, and there's only so much automation that you could put in place, for a mine, right?
And the very high price of the obviously the delta in terms of the environmental legislation, much more expensive to do things in the United States. You point out the shortage of skilled workers, the people who have these skills to do these things. I guess there's a savings on transport. These are very large, heavy materials that have to be brought over by barge, I would imagine.
Yes, and deregulation. I mean, Trump's faster permitting and maybe less onerous, some less onerous restrictions that have increased the cost of certain things. I think Biden offered loans and grants, but you had to jump through a couple of hoops to get them that may have added to the cost of some of these items. But the reality is, inflation, getting inflation from kind of 3% to 2% is the problem today, whereas a few years ago is getting it from 1% to 2%. Okay, so I'm not suggesting we're going to have stagflation, but I think we're going to have higher than normal inflation. Commodities historically have been an inflation hedge. It's just an argument. Do you want an inflation hedge? Gold and other commodities are seen as inflation hedges, and retail investors and other investors will say, okay, yeah, that makes sense. Maybe I should buy more commodities. Another factor is when I'm talking mainly about like mined commodities. I'm not really talking about oil and gas, in this. If you look at like big cap miners, for a lot of years, they've been paying, decent dividends because there was this big bust after the boom in, 2012, or a lot of investors in mining companies said, okay, you overpaid for assets. I don't want you to like grow through M&A, just pay back your cash flow. So in contrast to, the Mag 7, everyone's growth. The mining companies have been good payers of dividends over the years. But now a lot of those investors, after 10 years of doing that, are recognizing, okay, we do need to invest in growth through exploration, increase exploration budgets, as well as, do some M&A. So you're starting to see, there was a big acquisition into lithium. Rio Tinto, one of the biggest miners in the world, bought Arcadium, the third or fourth biggest lithium company in the world, that completed earlier this year or late last year. You've seen other things like Anglo American and BHP, or BHP bid for Anglo American, but it got rejected. Glencore bid for Teck. I think that got rejected. But you're starting to see M&A activity. That's another reason, in mining companies, you're getting income, you're getting growth, and you're getting M&A potential in, so we might see a cycle, for that. But look, there are risks here. Commodity equities follow commodity prices. As I said, many commodity prices, in particular, not just lithium, but other battery materials, are low, and they're low in part due to China manipulation. Government has supported investment in controlling supply and not so much on profitability. So they've artificially depressed prices because they look downstream. They want to support their battery companies and their EV companies. So they're okay if they can get cheap raw materials, right? Or they can make a loss on some of those raw materials, as long as, the end game is they're exporting, leading edge, cars and batteries.
Well, Howard,
But
that's as fresh as this very moment's headline, what we're seeing in markets right now. Talking of which, we got a viewer question from Paul E., who's one of our regular viewers here, who always comes to us with very well thought out questions. And the question that he asked is probably one that a lot of folks are wondering now is, which is this? What is the best way for a retail investor to jump on board? They're interested in the thesis, Howard, and they want to hear about ways that they can trade it.
Well, that's a great question. And so everything, just by the way, so not financial advice, every stock or ETF that I talk about, I own, and as I said, I'm not so much focused on oil and gas. I do own a little bit of the GDX and GDXJ. These are the gold equity indexes, a big cap index and a small cap index. But a way to play broad-based, by the way, all of these things have taken a major hit in the past few weeks. So PICK is the iShares MSCI kind of global metals and mining ETF. So there's no gold in this and there's no energy in this. So this is like hard rock mining, but it's focused on, the big cap miners like BHP, Rio Tinto. So this will give you exposure to iron ore, to aluminum, to copper, to nickel, to manganese, big traditional coal, traditional, mined commodities. And some of these companies have some position in lithium and others, but that's the most diversified way if you wanted broad-based exposure, X gold, X oil, to that commodity versus Dow chart that I mentioned. I think
okay, if you want exposure, X gold, X oil, this is PICK, iShares MSCI Global Metals and Mining Producers ETF. As you point out, it's been beat down over multiple time horizons here, which is precisely your point. Particularly year to date, it's a pretty ugly looking chart, as well as over the trailing 12 months. So this is the idea of that you see that this is ahead of the curve in terms of
yes. And then if you want to go individual commodity, like I like copper, I'm very bullish copper. And you saw that visual capitalist chart that I showed you over there, copper and lithium. I don't know a lot about individual copper names. So I own the Global X Copper ETF, that's COPX. This gives you, it's only copper producers, and some copper producers also produce gold. So I guess you're getting some gold in that, but it's mainly, it's a pure play way to bet on the copper price through a diversified group of the biggest copper producers in the world.
And you can do it directly through a brokerage account, futures account, not required. It's an ETF.
Absolutely, exactly. It trades like a stock, like any ETF. Another ETF, we didn't really talk about this yet, Ben. I don't want to go in great detail about it, but I am a big fan of nuclear. Nuclear is, and a way to play nuclear is a uranium ETF. So URA, it's not perfect because the weightings of it, the uranium market is small, like the lithium market is small, but as a way to play rising, the potential rise or potential further rise in price of uranium. Uranium rose quite a bit in the last kind of couple of years, but a lot of people believe in nuclear versus batteries, or solar and wind and batteries. So again, Secretary of Energy Wright is a big fan of nuclear. You've seen a couple of the Mag 7 looking to restart old nuclear plants in America. China's building out a lot of nuclear plants. So uranium had a massive boom, about 10 or 15 years ago. And some people believe, we'll have that again. Others are arguing that nuclear is a bit further out. It takes a long time to get small modular reactors, still an unproven technology. So some argue that the uranium trade might not be for 4 or 5 years, but I don't know. It's hard for me to time uranium. I'm not a uranium expert, but I own URA, to play, to be bullish on nuclear. And then, in lithium, when I last came on here, we were talking about Albemarle. Albemarle is virtually like round tripped. Albemarle entered the lithium business in 2015 by purchasing Rockwood Holdings. I think they paid $50 or $60 for that. The stock is maybe $70 today. It's been as high as 300. They've paid dividends all along the way. So as a proxy, that's the big caps, the largest lithium mining company in the world. And if you believe in the lithium thesis, that stock will go up, and it could get bought. Companies like Exxon and a few other major oil companies have started to dip their toe in the lithium waters. So Albemarle, like Arcadium, just got bought by Rio Tinto, is always thought to be a potential candidate from a big oil company or anyone seeking to enter the space. And I think it's less than 10 billion market cap, down from 30 billion. I speculated Tesla might have bought it a few years ago. So Albemarle is a pure play way to play lithium, but there is Sprott has a new pure play lithium ETF called LITP. That's pretty small, but it is a pure play. It gives you exposure just to lithium developers. The more popular ETF for lithium is the Global X LIT, but that's only about 30% lithium. The rest is kind of battery tech. It's called the Lithium and Battery Tech ETF. So it may include Tesla, BYD, if you want exposure to, the big battery and EV companies. You could own that share. And if you want to speculate on some earlier stage producers in lithium, I've recommended this story before. Piedmont Lithium, when it was, $5 or $10, it went as high as $80. It's now back down to $6. They're merging with a company called Sayona Mining, but they're now in production of spodumene, and one of their customers is Tesla. So that's an interesting story, as is Lithium Argentina, which is both of these companies are traded on U.S. exchanges, ticker symbol LAR, that they're partnered with Ganfeng, a Chinese company, making lithium carbonate from Argentina to go to China. Argentina under Milei, I think, is a story that's underappreciated. Trump and Milei and Musk and Milei, the libertarian with the chainsaws, they're very much in line with each other. So a few years ago, there was a big rush into lithium in Argentina. You haven't seen a big rush into lithium in Argentina in the last 2 years because the lithium price has been depressed. So I like those three lithium individual names: Albemarle, Piedmont, and Lithium Argentina.
Great.
And I can name one last, if you haven't, unless you have another question. There's only one other more speculative story I could talk about that's quite interesting.
Well, Howard, we're tight on time right now. We're going to have to save that one for the next time. But this has been an incredible conversation to talk about the geopolitics, what's happening in markets, all the underlying physics, chemistry, and technology that's driving this trade. And then for the individual names that you just mentioned there, what a fantastic conversation. I wanted to give you just a minute or two to give us final thoughts and key takeaways from this conversation because, man, this has covered tremendous amount of ground here.
Well, thanks, Ash. Just a little bit of a promo for myself. If you're interested in all of these topics, I mean, my partner Rodney Hooper and I are publishing 2-3 videos a week to talk about individual names in the lithium space, and the nickel space, and the titanium space, and the cesium space. And we have access to a lot of research and good ideas. So if you're interested in hearing more about these topics, please reach out to us. You could email us at rockstockchannel@rkequity.com, or please follow us on YouTube or Spotify or Apple Podcasts. But broadly, Ash, I just think that what I dabble in is the most risky part of any investment you could think of, right? So commodities are risky, highly volatile. A lot of them are in emerging market countries. That's inherently volatile. And a lot of the companies I focus on are basically public venture capital. So they're pre-revenue companies. So a beauty of the commodity, sector, unlike, some tech, like you can't invest in a lot of tech companies like Uber or Facebook until they're multi-billion-dollar companies. In the commodity space, the stuff we dabble in, if you could stomach the volatility, you can get venture capital like returns, in sub 50 million market cap companies in a lot of instances.
Yeah, that's really well said and an important disclosure, and I'm glad you made it. Howard Klein, what a great conversation. I hope you come back and join us again soon so we can keep following up on these topics.
Thanks a lot, Ash. Anytime.
Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
Before we close, I wanted to mention one company that didn't come up earlier, the metals company. The metals company trades on the NASDAQ, ticker symbol TMC. They're advancing a project focused on collecting seafloor polymetallic nodules, which contain key electrification metals like nickel, cobalt, and manganese. Over $600 million has been spent to date to reduce technical and environmental risk. Recently, regulatory clarity has improved with the Trump administration, signaling support for permitting processes related to domestic and allied mineral supply. Yet the stock is still trading at just pennies on the dollar compared to its fundamental resource value. While the company remains in early stages and carries risk, it's a notable example of the kinds of unconventional assets being considered as part of the broader shift toward electrification. We'll continue tracking stories like this as the landscape evolves. Don't forget to like and subscribe to Rockstock channel and let us know your thoughts in the comments below.